The S&P 500 today, its worst day going back to April 21st. You know, that was kind of in the midst of so-called Liberation Day.
Yep.
But was that after the president went back on the tariffs? I'm just thinking in real time now.
On April, so the
April 2nd was so-called Liberation Day.
That was so-called Liberation Day. And then we saw that big steady drop into around the first or second week of April, dropping nearly 20%. He was clearly a little bit scared of official bear market territory there. Before he finally put the pause on, we fell just below 5,000 on the S&P 500 before the pause was put on.
Yeah, and look at that. You can see the S&P 500 surging just almost 20% going back to those just before those April lows.
I mean, this is, if anything, we've had this broader bull run, but we've definitely seen, and we're likely going to see increased volatility from this market because of sensitivity around tariffs. And the 3Q earnings season is going to tell us a little bit more about what's happening. But I mentioned this actually the last time we spoke, that I think a bit of a dangerous precedent had been set, maybe in the first and second quarter on earnings calls, that tariffs weren't really a big deal yet. We run an NLP model. It's natural language processing. We determine how positive or negative management is on any given topic on earnings calls. And we found that they're actually getting broadly more positive when they discuss tariffs. I think right now the message to investors is the worst case scenario didn't happen. Everything didn't fall apart overnight. But there is definitely going to be some fragility and skepticism in a market that's trading at all-time highs, at a very high valuation, for any scent of what might be going wrong with tariffs, especially during the 3Q earnings season and going forward. And really what most of this sell-off is about today is Trump threatening those higher tariffs. I don't think the market knows exactly what to think about this right now because we had such a strong 1Q and 2Q, and we're maybe waiting for the shoe to drop or to see if companies can actually navigate this.
How much more vulnerable is the equity market for that shoe to drop when you start to factor in concerns around AI spending? Yeah. I was just at a conference last week with David Einhorn.
Wait, that's a different conference?
It was a different conference than the one I went to this week. But he started talking about how he thinks there's going to be potentially the risk of a lot of just overspending on AI. That even though he's bullish on AI more broadly, some of these companies look like they're just spending too much. They're not going to see the return that maybe they expected on that.
I think we're moving into that phase of the AI trade of, there have been a lot of promises. We actually want to see companies getting more efficient. I think one of the problems, at least that we're seeing right now in the market, is that a lot of the gains so far for the second half are coming from AI. It actually is looking similar to what the market looked like, at least the S&P 500, in the first half of 2024, right before we got a bit of that bout of volatility in the summer. We're seeing a similar amount of concentration start to emerge. Somewhat maybe more problematically is we're seeing that concentration emerge across the globe now. A lot of the emerging market trade is also riding on this AI thesis. And I think in terms of the amount of AI spending, one thing that may be getting underplayed right now is it's not just about the AI names that could be at risk if the AI thesis doesn't work out as investors think. It's also the companies that are investing in it. So things like financials, things like even consumer discretionary firms, even though they are not AI firms, people think, oh, well, there's only really a risk for the NVIDIAs of the world, the tech space. Now the risk is spreading to companies that are investing in it. And it's risk with potential reward. This could have a huge upside for productivity. The market just doesn't know yet. So it's going to be a little bit shaky anytime there's good news spiking up, anytime there's bad news spiking down, because they haven't really sussed it out.
Gillian Wolff, she is going to be even busier than she usually is next week when bank earnings kick off. Yep. She's global equity strategist for Bloomberg Intelligence. We are going to be speaking to her a lot in the coming weeks. Check out her research and more on the Bloomberg terminal. And you can also find the latest when it comes to all of that research at Bloomberg.com as well. Well, we did mention that the vast majority of stocks are lower today, but there are some bright spots if you're long this market, including U.S.-listed rare earth and critical mineral stocks surging today, extending gains after China unveiled new export curbs and as the U.S. government gets more involved in the industry. Deaux is economic statecraft reporter, but he knows a thing or two about rare earths and critical minerals. He joins us here in the Bloomberg Interactive Brokers studio. I don't understand, Joe. I thought that we need the critical minerals from China, the processing at least, that China is able to do. Yet there are a lot of U.S. companies, or a handful of U.S. companies, that are getting a lot of attention right now because they have access to at least some of these.
Yeah. I mean, let's just talk about today's action in the market. Broader market is getting destroyed. and then here's this domestic rare earth related, magnet related industry that's going up. I was talking to somebody earlier today who said, listen, the conversation a couple nights ago was, because I say a couple nights ago because this is all happening based on an export control reaction from China that happened 2 nights ago. And then the president finally tweeted about it today, which apparently brought to the attention of a broader audience maybe the significance that's at play here, both for the tariff negotiation and for the export control negotiation. But this source said to me, the initial reaction within domestic industry is great. This means you need to build out the domestic market more, right? So you're not getting supply elsewhere. So you're short on supply. So that gives upside to the stocks of the companies involved in building out domestic capacity here. Okay. So that's the trade. That's why you would have those numbers going up for those companies. But the real discussion is we're seeing in broad daylight, in public, what's really at stake in terms of leverage for the China-US trade conversation and negotiation. China has now used multiple times export controls on rare earths and rare earth magnets as its leverage, and the United States has used chips and AI chips as its leverage. The big deal here today is that it's the equipment that matters most. This is China saying, we realize you need our equipment to make those chips, to make those products, to process these materials, but also there are a lot of materials that come out of that come out of China that you need for any manufacturing equipment whatsoever.
Okay, so that's the movement today.
Yeah.
But the big picture is still that the U.S. is incredibly reliant on China for the processing.
Right. We're seeing just how far China is willing to go in this trade negotiation to push the United States to give concessions that it wants. Presumably, the concessions are these higher grade chips, these low grade AI chips, and the access to have those. Because China will admit, hey, the U.S. is ahead of us on this technology, and we need access to it. And they know that the United States needs their rare earth minerals and these permanent magnets to make the end products that they need.
So the companies that are based here that have yet to get an investment from the U.S., we only have 15 seconds left, are all of them thinking, hey, we could be next to get an investment from the government?
Yes.
Put simply, this is like the statecraft that's happening right now.
You could call it that. You could call it a gold rush.